right, let's get right to it. Enbridge just dropped what they're calling record financial results. And on top of that, they've announced a staggering, and I mean staggering, $39 billion secured capital backlog. Now, this is a titan of the energy infrastructure world making a massive, massive move. So the question we have to ask is this: is the company building an absolutely unshakable foundation for your portfolio? Or is the sheer weight of its ambition creating dangerous cracks right under the surface? Welcome to Iron Financial, the place where we forge stronger portfolios by stress testing the market's biggest names. Today, Enbridge is going under the microscope. Let's get to work. Okay, here's our battle plan for today. First, we're going to forge the bull case. Then, we'll inspect the financial engine to see what's really going on under the hood. Third, we'll weigh that heavy debt load. After that, we'll analyze what I call the dividend cornerstone. We'll look at how they're building for the future, and finally, we'll deliver our iron verdict. Let's dig in.
Okay, so let's start by building the argument for Enbridge. To really get this company, you have to understand its foundation. We're not talking about some small-time player here. We're talking about an absolute behemoth in the North American energy landscape. And honestly, their latest results are a powerful testament to that incredible strength.
You have to understand what you're looking at right here. This is so much more than just a collection of pipes and tanks and facilities. This is the circulatory system. I mean it. These are the very arteries of the entire North American economy. They move something like 30% of the crude oil produced in North America. They transport about 20% of the natural gas consumed in the U.S. These are not assets you can just go out and replicate tomorrow. They are a wide moat, absolutely critical, and frankly, an irreplaceable foundation for our entire way of life.
$39 billion. Just let that number sink in for a second. And listen, this isn't some wish list. This isn't a 5-year plan that they drew on the back of a napkin. This is their secured capital program. Now, what does secured mean? It means these are projects that are commercially secured. They have customers lined up, contracts in place, and a clear path forward. This number represents a powerful, preloaded engine for future growth that is already being bolted onto that massive foundation we just talked about. It is an undeniable signal of confidence for management.
And this chart right here, this is the result. This isn't speculation. This is the trajectory they're on. Look at this. This is the hard evidence of that growth engine just firing on all cylinders. What we're looking at is adjusted EBITDA. Now think of that as a really good measure of the company's core operational profitability before you get into interest, taxes, and other accounting noise. It's climbing from $18 billion in 2024. It's projected to hit the midpoint of nearly $20 billion in 2025, and then it's pushing past $20.5 billion in 2026. This is exactly the kind of steady, predictable upward march you want to see from a mature blue-chip company. It's a predictable earnings machine.
Whoa, hold on a second. EBITDA, big capital programs. Those are great headline numbers. I mean, they look absolutely fantastic in a press release, don't they? But look, anyone who's been in the market long enough knows that earnings aren't always cash. I want to look under the hood. I say we inspect the real financial engine. Show me the actual, real cash this business is generating before we go ahead and declare it a fortress. You know what? That is a fair challenge. And you are absolutely right. Cash is king, always. That's why for a business like Enbridge, we have to focus on this metric, distributable cash flow, or DCF. Let's be crystal clear about what this is, because it's important. Unlike net income, which can be filled with all sorts of non-cash accounting items like depreciation, DCF is a much cleaner, much more honest measure. It really represents the actual cash that the business generates. It's the money that's left over after running the day-to-day operations and spending what's necessary to maintain the existing assets. This is the pile of cash they can use to pay us, the shareholders, via dividends, or reinvest for more growth, or, importantly, pay down their debt. It is the true measure of financial health and strength.
Okay, so where is that cash actually coming from? This table breaks down the engine components for their projected 2026 EBITDA, which, remember, is the starting point before we get to DCF. So the liquids pipeline segment is the absolute workhorse, the foundation of the foundation, bringing in a massive $9.6 billion with incredibly stable volumes. But look at the growth drivers. The gas transmission business is set to add around $5.5 billion, and that's being fueled by new projects coming online and important rate increases. Then you've got the gas distribution and storage business. It's another monster, kicking in $4.5 billion as they put new capital to work. And even the smaller renewable power segment provides a stable, predictable $700 million. So the crucial point here is this isn't growth from just one single source. It's diversified and it's robust across all their core operations.
Diversified, robust. I hear you. I do.
But building an empire like this, it isn't free. That $39 billion price tag doesn't just pay for itself. All this expansion, all these acquisitions, it leaves a trail. And that trail is debt. So I think it's time we stopped admiring the fortress walls and we started actually looking for cracks in the armor. Let's talk about the real cost of all this growth. Honestly, this is the most important question an investor can ask about any company. How are they paying for this? You've got $39 billion in growth projects, plus they've mentioned another $14 billion in maturing debt that they have to refinance. That is a huge amount of capital. You can't just pull that kind of money out of thin air. We need to understand the financial structure that's holding all of this up, because if that structure is weak, the whole thing is at risk of crumbling.
And right here, this is where the rubber meets the road. This table lays out their own calculation for DCF in 2026. And yeah, the top line, that adjusted EBITDA, is a massive $20+ billion. It looks great. But my eyes go right to one line, financing costs. Look at that number, $5.425 billion. That is over $5 billion of their earnings. That doesn't go to growth, it doesn't go to dividends, it sure as heck doesn't go to us as shareholders. It goes straight to their creditors just to service the existing debt they already have. And the company's own notes admit this is driven by a higher principal debt balance. That's not just some line item, that is a significant drag, a heavy, heavy anchor on their cash flow.
That's a heavy number. I won't deny it. It's huge. But context is absolutely critical here. No company of this scale in this industry operates without leverage. It's just not possible. The real question is whether that debt is managed and disciplined. And this slide shows Enbridge's own publicly stated target. They aim to keep their debt-to-EBITDA ratio within a specific range of 4.5 to 5.0 times. Now, for a fast-growing tech company, that ratio would be a death sentence. But for a utility-like business with extremely stable, contracted, predictable cash flows, this range is actually considered investment grade. It's the framework they use to ensure the debt remains serviceable. They're telling the market, yes, we use debt to fund accretive growth, and accretive means growth that increases our earnings per share, but we are committed to keeping it within this responsible range.
A target is just that. It's a target. It's a goal. It's a nice thought, but it is not a guarantee. And since we're talking about guarantees, let's look at what Enbridge's own lawyers say in their financial statements. I want to read this directly because this is just crucial. Quote, "Such statements are not guarantees of future performance, and you are cautioned against placing undue reliance on forward-looking information. By its nature, it involves a variety of assumptions, known and unknown risks, and uncertainties." And then they go on to list things like interest rates, inflation, and economic growth. So while they have a nice target, they are also telling you in plain black and white legal text that if interest rates stay higher for longer, or if inflation drives up the cost of their projects, those beautiful projections could change in a hurry. Relying on those forecasts without acknowledging these very real risks is a trap. You are absolutely right to point out the risks. Every single investment has them, and those are real. But while you're focused on the potential cracks, I want to pivot to what I believe is the cornerstone of this entire structure, the part that has held firm through multiple economic cycles, through dramatic interest rate changes, and through all kinds of market volatility. And that is the direct cash payout to shareholders, the dividend. 31 consecutive years. Just look at that. They haven't just paid a dividend, they have increased it every single year for over 3 decades. That isn't just a policy, it's a core part of this company's DNA. This track record is, in my opinion, the most powerful piece of evidence for the bull case. It demonstrates a level of financial discipline and commitment to shareholders that very few companies on the entire planet can match. This is reliability that has been forged in steel.
And this makes it tangible. This isn't just a story. For 2026, the company is projecting a dividend of $3.88 per share. This isn't some abstract concept. It's the cold, hard cash they plan to deposit directly into their shareholders' accounts. For investors who are seeking income, especially in an uncertain market like the one we're in today, this is a powerful and very concrete number. It's the primary reason many investors own this stock in the first place.
And this donut chart shows exactly why that dividend is so secure. This isn't a company that's stretching every month to make its payments. Their target is to pay out only about 65% of their distributable cash flow. Now, what does that actually mean? It means that for every dollar of real cash they generate, only about 65 cents goes out the door to the dividend. The other 35 cents is retained inside the company. That is a huge cushion. That retained cash, which adds up to about $10 billion of it, is what they use to help fund that massive growth program we talked about and to manage their debt.
So the dividend is not only safe, it's intelligently structured to allow for continued investment in the business. So let's talk about where that reinvested cash and all that new capital is actually going. That $39 billion secured program isn't just some number on a page, it's a strategic vision for where Enbridge is headed over the next several years. Let's break down exactly how they're building the future.
This is their two-pronged strategy in action, and you can see it right here. On the left, you see their bread and butter, modernizing and expanding their core pipeline infrastructure. This is all about making their foundational assets safer, more efficient, and capable of meeting future energy demand. But on the right, you see the future. They are making significant multi-billion-dollar investments in renewable power. We're talking solar, wind, both on and offshore. They are not just an oil and gas pipeline company anymore. They are executing a deliberate, long-term strategy to be a dominant player in the energy transition while simultaneously strengthening their indispensable traditional business.
So let's move to the timeline and see how this all builds out. This isn't all happening at once. It's a very sequenced, very methodical, multi-year plan. In 2025, we're going to see the initial deployment of these new projects. Then in 2026, the real heavy lifting comes online, with major gas and utility projects starting to generate cash flow. And beyond that, from 2027 onwards, the long-term growth from the liquids and renewables side really kicks into high gear. It's a clear, logical path to growing the business. You know, it's a clear plan, I will give you that, but a plan this large, spanning this many years and multiple business lines is absolutely loaded with execution risk. Delays, cost overruns, regulatory hurdles, a lot can go wrong between a pretty PowerPoint slide and a project actually producing cash flow. That 35% of retained cash gives them a buffer, for sure, but complex multi-billion-dollar projects are never, ever a sure thing.
All right, we've laid out both sides of the argument. We built the bull case on a solid foundation of irreplaceable assets and secured growth, and we've stress-tested that debt load and highlighted the very real risks. Now it's time to bring it all together and forge the iron verdict. Is Enbridge a massive opportunity, or is it a carefully laid trap?
The case for the foundation is just incredibly powerful. You have a massive, critical asset base that is simply unmatched in its scale and importance. You have $39 billion in secured growth that is already locked in and ready to go. You have a 31-year history of consecutive dividend increases, and that's backed by strong and growing distributable cash flow. I mean, this is the very definition of a blue-chip bedrock investment. But you cannot ignore the cracks in that bedrock. That foundation is supporting a very significant debt load, and the cost to service that debt is over $5 billion a year, and it's rising. Their own documents admit they are sensitive to interest rates, and as we just discussed, there is major execution risk in a capital plan of this magnitude. A shift in the economic winds could put serious pressure on this entire structure.
So here is our synthesized iron verdict. Enbridge is an undeniably powerful cash-generating machine. Its assets are absolutely world-class, and it has a clear, visible path to growth laid out for everyone to see. But it is a machine that is being weighed down by a heavy and an expensive debt structure. The verdict here truly hinges on two key factors: management's ability to execute on that $39 billion plan without major hiccups, and of course the future path of interest rates. This is not a stock you can just buy and forget about. Investors need to be vigilant and monitor that debt very, very closely.
So, the crucial question we leave you with is this. After seeing the undeniable strength of the foundation and the sobering reality of the cracks, you have to decide for yourself. Is Enbridge a bedrock for your portfolio? Something that can offer stability and income for years and years to come? Or is it a foundation that, under the immense weight of its own ambition and its debt, is beginning to show dangerous cracks? The decision, as always, is yours. Thanks for joining us at Iron Financial.
Disclaimer: everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.